Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights. I'm your host, John Kasman, the founder of Kasman Capital Group, and I want to thank you for joining us for another great episode. Now, if you're enjoying this podcast, do me a favor, take a minute and leave us a 5-star rating and review. And if you haven't already, make sure you hit the subscribe button so you don't miss an episode. Now, if you're interested in multifamily and want to review a sample deal, you're in luck. And we have a special download on our website of a sample deal package. Just go to kasmancapital.com/sample deal, and you'll also join our mailing list to get tips and exclusive investment opportunities. Now, today we're going to be talking to a cost segregation and LinkedIn expert, Mr. Yonah Weiss. Now, Yonah is a powerhouse with property owners' tax savings. As business director at Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. With that said, let's welcome to the show, Yonah Weiss.
Thanks for having me, John. It's a pleasure to finally get on the show with you in video form nonetheless.
Yes, sir. Yes, sir. I think you're like number 2 or 3 or something like that on the video. So if you are listening to the podcast and want to see our beautiful faces, you can head over to YouTube or the website or any place where this video might get posted. I'm not even sure yet, but you can check over and see the video. Otherwise, by all means, all the information is going to be the same. So certainly check out the podcast wherever you're listening to it. So Yonah, you and I have known each other for a little bit now. We've actually done some work together. And, one of the reasons I wanted to have Yonah on is he is one of the experts in regards to cost segregation. And, I want to, before we dive super deep into that, I want to really help folks understand what cost segregation is. And before we even jump into that, one of the things people love about real estate are some of the tax benefits, especially those folks who are maybe focused more on investing in stocks or, other asset classes. Can you talk about some of the benefits of investing in real estate and kind of lead into the benefits from a cost segregation perspective?
Absolutely, John. People invest in real estate for all sorts of reasons. I mean, the top 3 that come to mind are, your equity appreciates over time, meaning the property, the value of your money actually grows because of its investment. And that's, related to many other type of investment vehicles, stocks or bonds, whatever, albeit real estate generally has a much higher threshold, therefore a much higher returns on investment as opposed to other types of traditional investments. The other, major benefit that comes with it is really the cash flow that comes through real estate investing, which, as opposed to many other types of investments, it may be a long-term investment similar to real estate, but you're going to have your money not only tied up, but, you're not going to get those dividends returned to you at such a fast pace as it will be with real estate, where, many investors will receive quarterly returns, some even monthly or bi-monthly returns on their investments. So that's something that, you have to keep in mind as opposed to, receiving a yearly dividend on your investment or something like that. The tax benefits also with real estate are, famous. Everyone knows that depreciation, right, is a tax benefit, a tax write-off that you get for owning a property. But some that are a little bit less known are what we're going to get into today, which is cost segregation, which is like a, depreciation on steroids, basically, right? It's like depreciation to the, taking it to the next level. There are so many different real estate benefits, investment benefits when it comes to real estate investing. But I think those are the 3 main ones: the appreciation of your capital, the cash flow that's coming from it, and the tax benefits coming along with it.
Absolutely. Appreciation, cash flow, the tax benefits when you get into depreciation. Those are 3 really strong aspects that all of us really look for in investments, and real estate happens to provide that trifecta. Yonah, I should have started with this, but I kind of read your, a little bit of your bio. Before we dive deep into the cost seg piece, why don't you take 30 seconds and give our listeners a little bit more of a background of who you are?
All right. Yeah. Thanks so much. Actually, my background is, I grew up in Southern California, but ventured out to Israel to study. And I was there for, about 15 years studying, teaching in various aspects, and got into real estate really only about 5 years ago when I learned to, want to be a broker. I learned residential brokerage, a commercial mortgage broker. I wanted to really get my feet wet in every aspect of real estate. So just really apprenticed people who were successful in different areas of real estate, which led me to the company that I'm at today, Madison Commercial Real Estate Services, which is a national company. I have a number of different services, title insurance or due diligence, financial due diligence, lease abstracting, 1031 exchanges, and cost segregation, which are really, each one of them different niches within the commercial real estate space. And some of the, attorneys and accountants and principals of the company have had the pleasure to, just shadow and apprentice people who've been in the real estate industry, both as owners, investors, and in this service industry from a financial perspective has really given me, such a wealth of knowledge and understanding from that kind of not firsthand perspective, but I learn much better by shadowing others and by apprenticing people who are successful as opposed to, just book knowledge.
No, I love it. Thank you.
Yeah. But my background in teaching, gives me that ability to integrate what I'm learning and give it over in a way which I think, I've kind of formed a little bit of a niche in doing that.
All right. So thank you for clarifying and giving a little bit more background. So, Yonah, we've talked a little bit about depreciation, right? So typically on a piece of real estate, you can depreciate that asset over the course of 27 and a half years. There's a phrase called bonus depreciation. There's something else called cost segregation. For folks who aren't as familiar with these terms, can you explain what bonus depreciation is as well as cost segregation?
Sure. So maybe let's take a little step back and explain depreciation just a drop so we all understand it. It means, the property value is going down over time, which is a little bit of just a theoretical because the property is usually going up in value as time goes on. Nevertheless, the tax deduction is called depreciation because it's based on the concept, and I say theoretically because it takes the property value from the day that you purchased it, really the capital that was put into the building. So, your purchase price minus the land value, and you get that as a tax deduction over, like you said, 27 and a half years. That's depreciation. So you get a little bit of a deduction every single year, split up, and it usually helps to reduce your income tax liability, which, is great. And that's one of the tax benefits. You're making money, but you don't have to pay taxes on all of it. That's what depreciation does. Cost segregation actually allows you to break down the property into different depreciation lives and really faster depreciation lives. Because the IRS says that, the building, the main structure of the building depreciates over a 27 and a half year period, or actually 39 for commercial properties, not including multifamily. Nevertheless, there are things in the building besides the main structure that depreciate on a 5-year schedule. Okay, things like appliances or furniture, carpeting, fixtures, special purpose lighting and plumbing and things like that really are in the building, and you buy it when you buy the property, but it's not tied down to the building and is not part of the main structure. Those all depreciate on a 5-year schedule. And there are things that depreciate on a 15-year schedule, which are land improvements. So things like landscaping, pavement. If you have a parking lot, driveway, or sidewalk on your property, all of that has value to it. And the value of those assets can depreciate over a 15-year schedule for land improvements. So the process of cost segregation is really, just take the name, the segregation, which has a bad connotation, right? But it means breaking out the pieces, right, of the building by their costs, okay, cost segregation. So the value, that's the dollar value that's placed on every individual specific asset within a property can be applied and then depreciated at a faster rate. So you might have in a multifamily property, you have a lot of, you have carpeting, you'll have, 20,000 square feet of carpeting, right? And that's priced out. An engineer can come to the property and based on the industry standards can measure that, value that, place a value on that, and show how that carpet is actually worth, $150,000, right? Because when you buy a building, you don't know how much every individual piece is worth. You know how much the whole thing altogether is worth. So that's how you have an engineer who is specialized in this can come to the property and identify all of those things, getting you that overall value and then reallocating them to faster depreciation lives.
So, Yonah, you mentioned the engineer and getting someone to come out there. I mean, could an individual do this by themselves, or could they look at the property and start to give some rule of thumb estimates to, hey, I have, let's say it's a 100-unit complex, I have 100 stoves, 100 refrigerators. I'm just going to say a couple $1,000s each. Or does it have to be an engineer that oversees that aspect of the deal, or they call segregation?
Right. That's a great question. The IRS has very clear guidelines when it comes to actually performing a cost segregation study. So you can look up the Cost Segregation Audit Techniques Guide, which was published by the IRS and has very clear guidelines. You can Google that. It's on the IRS webpage. In there are 13 principles of a quality cost segregation study. Now, they actually break down, before you even get to the quality cost segregation study, there is something called a rule of thumb study, like you mentioned, which means that a person can, if he has the knowledge of how much everything costs, he could go ahead and take a value of certain things, appliances, things, big ticket items that you could get. You have ID numbers, you may have receipts for, or you even have, not receipts because you bought the property, but you may have, like serial numbers on the appliances. You could use those to trace the actual value. There is still going to be a tremendous amount of work involved to get all of that, but you don't need an engineer per se to do that. Now, that being said, those type of rule of thumb studies, number one, are not recognized as quality by the IRS, which means they will likely not stand up to an audit unless they are to the T, right? Secondly, you're going to be missing out on a tremendous amount of value. In our experience, people who try to do a rule of thumb and just kind of guesstimate, even on an aggressive level, they're still going to be missing out on 20 to 30% of the potential value in a cost segregation study. Now, the other guidelines the IRS puts out are that there needs to be a common nomenclature, there needs to be a numbering system. There's a whole slew of things that actually go into a quality cost segregation study. So to do it right, having the engineer, which is one of those requirements, is a necessary factor, especially if you want it to stand up to an audit.
Got it. Now, you started talking about the depreciation schedule. You said that there's 27 and a half years is kind of the traditional for residential and multifamily, 39 for overall commercial.
Correct.
And as you look at getting into some of the the segregation or the separation of the different aspects, you mentioned 5-year for things like appliances, plumbing, HVAC, things like that. Right. 15-year for things like land improvement, sidewalks, and things of that nature. Lots of different schedules to identify. So obviously this is pretty complex for the average investor to identify this. As they look at the different schedules, how do they figure out, okay, this stove has 3 years left if it's a brand new stove, or if it's a 15-year-old stove? How are they factoring in the age of some of these materials in this cost segregation analysis?
That's an excellent question. The main benefit of depreciation in general and cost segregation is that it actually starts when you purchase a property. So if you purchase a property which was built in 1910, right? I mean, I think your building that you guys bought was
purchased in 1910.
Right? It was an old building, right?
Yeah.
But nevertheless, and you may have appliances that have been in there since the 70s or who knows when, right? Stuff in there that hasn't been replaced for a long time. Nevertheless, when you buy that building, your depreciation starts over from day one. And that includes everything that's in the building. So even though the stove, the refrigerator, I mean, I once lived in an apartment, the refrigerator had been there for like 30 years. It still worked. It was awesome. It was like, but you start over from day one as if the refrigerator was brand new from a depreciation standpoint. And that's why I preface this whole, discussion with depreciation and conservation is really theoretical. It's a theoretical tax deduction. There is one point that I will add to that. In the actual cost segregation study, there is a factor that is applied, which has to do with the actual useful life of the asset, like the stove or the fridge, versus when it was placed in service. So when it's placed in service, when you bought that building, however, the actual useful life, is like, it's 5 years, right? But this was, put in there 30 years ago. So how do you factor in, how you reconcile that difference? There's a calculation as part of the study that goes into it. It's a very minimal difference because you still really get the benefit of that 30-year-old fridge. You still get the 5-year benefit of depreciating that, which is incredible to me. And when you go and sell that property to another guy, he gets to start over his schedule, from day one, based on how much he paid for the building.
So, Yonah, this sounds really interesting, but for that listener who's saying, cool, so what? Like, give me some real tangible examples of what is the real benefit? Help me understand. What is this going to do for me? Why would I actually take the time to pay an engineer to come out and do this cost segregation analysis on my property?
Awesome. So let's say you buy a building for $1 million, right? And I know you guys, your building was somewhere around that, right? A little bit less. So for $1 million property, and usually I say that's like the threshold where you're going to see tremendous benefit, right? From $1 million and up. Less than that, there's still going to be benefit there, but you obviously should look into it, run the numbers, and see if it makes sense for your situation. What's going to happen? The engineer is going to identify all of that stuff, all the appliances, all the fixtures, all the furnitures, and prepare this whole study, come up with a number and say, hey, all of that stuff adds up to X number, which is 20%, let's say, of the actual purchase price or the actual depreciable basis. Remember, we separate a little bit for land. Land doesn't depreciate. So whatever the basis is, 20% of that is now this 5-year property. So if you have $1 million property, you're looking at about a $200,000, give or take, value that is now can be depreciated on a 5-year schedule, which means you're getting, besides for the regular depreciation deductions that you're going to get an extra, right? $200,000 spread over 5 years, an extra $40,000 of deductions every year for the next 5 years. Now, that's the basic, value play over here, is that you're creating huge tax deductions, extra tax deduction, which will likely knock off your entire tax liability during that first 5-year period, right? Or a significant portion of it during that first 5 years, which releases and frees up your cash flow to do whatever you want with it, reinvest it in the property, reinvest it in a new deal, but it's the time value of money, right? We're not creating new deductions out of thin air. What we're doing is we're front loading a big portion, a big chunk of it to these faster lives, which, to segue into your previous question, what about bonus depreciation? This
real quick, Yonah, before we go into bonus, I'm good at math, but okay. I need a quick second. So I just want to make, for those people who are like me, I want to make sure we're tracking, right? So the example we gave roughly, I'm not going to go super deep into math, but the rough example was on $1 million property.
Right.
We would look at roughly, let's say it was the cost segregation analysis allowed us to take a 20% deduction, right? $1 million. There you go.
Okay.
You're saying
my whiteboard over here.
That could roughly, again, not guarantees, but it could equate to around a $40,000 deduction from a tax standpoint over the course of 5 years. So each year, you're taking $40K off. So for anyone who's looking at these deals and you're penciling them out, and you're looking at an 8% return if you're syndicating, or even if you're just looking to buy it for yourself, that $40K tax deduction could be pretty huge in kind of your overall returns, would you say?
Absolutely. Because when you're looking at it, like you said, when you're looking at it from, let's say, an 8%, return on the investment, well, guess what? That 8% return is before taxes, okay? But if you're looking at it purely from, after tax perspective, the benefit of that 8% is actually probably going to be more something like 5% return. With the cost segregation, it will actually, for those first 5 years, will actually truly be, an 8%. Because again, we're in most cases minimizing the tax liability to, minimal, if not negative, which means you're not going to have that tax liability during those early years, which is critical when you're establishing yourself, when you're establishing a property, you're trying to scale up from one property to the next, which literally can mean the difference. And I've seen it happen time and time again, the difference between, buying one property every 2 years, right? Because of the cash flow issue being tied up, to literally buying, 2 to 3 properties a year.
Yeah, wow, that's great. And just again, for those folks who are trying to follow the math, if we assume on $1 million property, you're putting 200,000 down. I'll use 20% because I like round numbers.
Right. Mm-hmm.
That at an 8% return, that's around $16K of cash flow is what you'd be looking at 8%. And we're saying here that same time frame, you take a 40,000 deduction from the cost segregation. So just to give you a sense, we're talking 16K cash flow returns, 40,000 in deductions. So you can start to understand why folks are really excited about things like bonus depreciation, cost segregation analysis, and things like that. Now you're getting ready to walk us through bonus depreciation. So
Right.
Let's do that.
Let's do that because bonus depreciation was a new law that came about in the recent tax reform, the Trump laws, right? They call it Tax Cuts and Jobs Act 2017. It started in 2018, really at the end of 2017, and said that any property that depreciates under 20 years, okay, so excluding the main structure of the buildings, we're talking about everything that we're segregating out, everything that we are accelerating the depreciation of, the 5-year category, 15-year category of personal property and of land improvements. All of that can now be depreciated. 100% of that depreciation deduction can now be used in year number 1, okay? Which means you can now take that entire $200,000, which we were spreading over 5 years just for our round numbers, and take that entire $200,000 as a tax write-off, a deduction in year number 1. Now, before you get all like excited and like, wow, it's amazing, I'm making $50,000 on this property and I get a $200,000 deduction, that's awesome, right? But it doesn't really make sense, right? The math doesn't add up. Like, why would you want an extra $150,000 of deductions? Like, what's the point? And the truth is, it's a very good question. There really is not, there's not necessarily a good point of it unless, and I'm adding in this huge caveat, unless there's something called a real estate professional, okay? A real estate professional is it's a terminology coined by the IRS, which for whatever reason, okay, we can get into theories of why they gave this huge tax benefit of it, but in plain English, the rules say if you qualify as a real estate professional, and I'll give the two qualifications in a second, you can now use depreciation as a tax deduction to now not only offset the income produced by your properties, but you can actually use those tax deductions to offset any and all income that you have produced from anywhere, okay? So, and this is especially important when people are, spouses are filing jointly, and one spouse is a real estate professional, makes that qualification, and the other spouse is not, and let's say is a high income tax earner, which means they're a high earner, right? W-2 job, whatever it may be, and they're going to be taxed at a very high income tax rate. Now, when you join them together, right, you're going to produce extra deductions, which is not going to cover the income produced from the property because there's only a small amount of that. The rest of it can now be used to offset all of that other income, which is now going to lower your overall family joint tax liability. So cost segregation, just to sum up that, and I'll get in what those two qualifications are, is most important when someone is a real estate professional. Okay. Otherwise, they may not be maximizing the benefits and may not be able to even use that And in many cases, the bonus depreciation will really be unnecessary.
All right, so Yoni, you've talked about there's 2 qualifications to be a real estate professional. What are those qualifications?
Awesome. So the 2 qualifications are, and either spouse can meet these 2 qualifications and jointly you qualify. So number 1 is that you have to spend more than 50% of your time, your working hours, not your time, but 50% of your working hours actively involved in the real estate industry. And that can be involved in managing property, developing property, constructing, operating, brokering, anything that's involved in the actual day-to-day of running, managing, operating, etc., a property. So if you own a property and you're actively involved as an investor, as running it, then you can use those hours to qualify for these 50% of your business hours. And the second qualification is it has to be 750 total hours for the year. Okay, and that's not a lot. I mean, it's about 16 hours per week. Or 3 months a year, depending on how you look at it. So you could go, to the Bahamas for 9 months a year and spend the other 3 right working on your real estate, and you'll be totally fine. So those are the 2 qualifications. And again, either one of the spouses can meet this qualification. And I know a lot of people that are, very high income earners, they have a corporate job and they're deeply involved in real estate investing, but they also want to take advantage of this status, which again will allow you to use the depreciation to offset all of your income. They'll have their spouse become a real estate agent and help and be involved, on a minimal basis, right? To whatever extent they can in the day-to-day running of the property. And that gets them qualified.
That's awesome. That's awesome. So outside of the real estate professionals, there are benefits to other folks, right? Especially when you look at passive investors. I know for us, when we're putting together deals, a lot of our investors really love the cost segregation component to it. Talk a little bit more about the other benefits if you're not a full-time real estate professional.
So you are going to be using those depreciation. If the depreciation deductions exceed your earnings from the property, that will be, show up on what's called a K1 distribution, a K1 sheet. That will put you in a negative, okay? Now, it doesn't go away. What happens is it creates like an imaginary bank account where that negative depreciation, that extra depreciation is stored and can now be used, further on next year if you need it. So it doesn't go away. So even though you're going to a negative and next year you may have a positive, or the year after, that depreciation can now be released and used to offset it further on.
And then too, like for, let's say you're a business owner, if you have K1 or other investments that have
Correct.
positive gains, this can also be used to offset some of that on your net tax liability, correct?
Right, correct.
Yeah. So I think that's the other piece too, is, even if you have a lot of our investors actually like you for that reason, because maybe they own a practice or they own, other business entities where they're getting those K1 distributions. And ultimately, you're going to stack all those up, add them up, and, you're either going to have a net loss or net gain. And that's what you're going to get taxed on. So this is a way to kind of bring down that. To your point, though, this doesn't work for everyone. It sounds like the number one person it works for is that real estate professional, because then you can start to take it against your W-2 or ordinary income. And then if you are a passive investor, there may be an opportunity at a minimum to offset any other passive income that you gain. But if you're just working a W-2, this really won't help you that much. But the benefit may be in the future because it will still be on the balance sheet and maybe something that you can tap into down the road. Yonah, you started talking a little bit about, kind of $1 million, that number where you think it makes sense. Who should be looking at this, and just give a little bit more context to who is kind of an ideal person to explore a cost segregation for their next project?
So it can be a next project, or it can even be a past project, because you can recoup the benefits retroactively. So even if you bought a property several years ago, and I usually say, within the past 5-6 years is really when you're still going to see the benefit. You can retroactively get those tax deductions that you would have accelerated. If you're going back 5 years, you can now get that, up front, all those tax deductions. So there's really going to be a tremendous amount for any property that's purchased for over $1 million. Again, it makes sense to run the numbers. Nevertheless, I usually don't like to do this on single families. There's really not a lot there. And besides the fact that the property is small, so there's not going to be a lot there to begin with, but you're also dealing with less actual assets. Okay. So like a multifamily property, you have a 30 unit building, you have 30 sinks, right? You have 30 appliances. The value of those things are going to be more than the one sink or the one appliance in that single family home. So it's going to be, the allocations, the percentage allocations are going to be higher on multifamily properties. Any type of property that's out there, and there are some properties that are actually huge when it comes to tax benefits. And I'll just mention a few of them because if someone who's looking, they're like, hey, I need huge tax deductions this year. I'm a real estate professional, but a regular cost segregation, even bonus depreciation is still not going to be enough, right? What do I want to do? And so a couple of those are golf courses. Golf courses are huge because they are almost entirely 15-year property, land improvements. Remember, you think golf course, it's just land, right? No, it's landscaping and, all that stuff that is actually considered land improvements that depreciates on a 15-year schedule. So that's already up from 39 regular cost segregation. But if you're doing bonus depreciation, you can get, and we're talking like 70, 80% of the property literally is put into that 15-year bucket. You can get that huge tax. So let's say you buy a golf course for $1 million, you're talking about a first-year tax deduction of potentially $700,000-$800,000. And so obviously, if you buy a golf course for $10 million, it's proportional.
Wow, that's amazing. That's a great tip, and I learned something there. I did not know that. So thinking about golf courses, are there any other types of investments if you're looking for a huge hit on that bonus depreciation that you should look into?
Yeah, another one will be mobile home parks, because especially when we were talking about all tenant-owned homes, right? So the park does not own any homes, and you just own the land. So again, what do you own? You don't own the homes. There's almost no 27.5-year property, and there's almost no 5-year property because you don't own the homes. Maybe you have a little office, and that's about it. So what do you own? You own the pavement, the pads that are under every home. Okay, all of that can add up. Again, it could be 50, 60, 70% of the property is usually allocated to those faster lives. So mobile home parks is another big one. And nursing homes or assisted living facilities, skilled nursing facilities, these type of properties where there's going to be actually a large amount of 5-year property, meaning the personal property, the equipment, the beds in every single room, all of that in each room, there's going to be a lot of that personal property, the equipment, appliances, et cetera, furnishings that are very expensive and therefore have a lot more dollar value to them.
I was thinking student housing as well would probably, if you do furnished student housing, might kind of fit that bill if you own the beds and everything else too.
Right. Well, yeah, that's true. There would be a little bit more, but again, it's not going to be as much as, because it's not going to be such, expensive ticket items as for the, the assisted living. Makes sense. Yeah, you're absolutely right.
Makes sense. So, Yonah, we've talked a lot about the benefits, lots of upside here. Mm-hmm. There has to be some drawback. What are those? Right.
Yeah. So number one drawback we already mentioned, which is that if you don't need it, okay, creating extra deductions out of thin air, right, front-loading deductions is not going to help you if you don't have that tax liability. So, forget the glamour of this great thing. It may not be for you, okay? So that's number one, which is the most important thing to factor in. Run the numbers, see if it's going to benefit you even up front. Now, the biggest, downside of it is really on the back end. Okay, the back end means when you sell a property, there's something called Depreciation Recapture Tax, which means you are now going to be taxed on the amount of depreciation that you took during the course of ownership of the property. That applies, across the board, whether you did cost segregation or not. You're going to now have to pay a tax on the back end of that depreciation that you took. And there are a couple things to factor in. So number one, if you're holding a property for a short period of time, very short, let's say less than a year does not apply, because less than a year, you don't even get depreciation. It's considered more of a business tax, not a rental property. But even if it's more than a year, between a year and 2 years, you have to strongly consider the tax benefits, the short-term tax benefits, versus the depreciation recapture that I'm just going to have to pay back. So there's usually going to be a margin, because depreciation recapture tax is at 25%, and sometimes the personal income tax rate is going to be much higher. So there's still going to be a spread, and that spread can still be beneficial even on a short term. However, since we're front loading a tremendous amount more, especially with bonus depreciation, you may be paying a lot more on the depreciation recapture tax because you're taking so much more depreciation up front. Two ways to get around that, okay? Because we're always looking for strategies, right? So that's something you have to take in consideration. You have to kind of look at what is your hold of this property. It's a 5-year hold. Are the benefits going to outweigh, paying back? And the simple answer almost always is yes, because the time value of money, having that now, is always going to be more than later. And the tax is usually going to be less than had I just paid up front the income tax now. So there's usually going to be that case, and there's always an argument against that. Okay, so obviously discuss this with your tax advisor. But the two ways to get around depreciation recapture tax, because we're always looking for strategies to pay little or no tax, right, legally. The one way to get around it is by doing a 1031 exchange. Okay, now you're not getting around it indefinitely, but you are further deferring those taxes, just like capital gains tax is deferred through a 1031 exchange. Also, the depreciation recapture tax is also deferred. Okay, so you're pushing it further down the road. The other very, not so simple, but kind of a strategy to get around this is by doing something called asset disposition, or partial asset disposition, which means you can, at the sale of a property, you can actually allocate a lesser value to those 5-year property, to those the stuff that had already been depreciated. You can allocate a lesser amount value to that. Therefore, the depreciation is no longer going to apply to, because there's not going to be a gain, right? Depreciation recapture is only when there's a gain involved. So they're just like capital gains, right? There's only going to be a gain. If there's not a gain on it, then there's no depreciation recapture on it. So if the value is much less, so there's not much depreciation recapture on that. And that's something that, again, you have to discuss with your accountant, see if that strategy fits with you. But I know a lot of people that do this, and it's pretty widely accepted even amongst the big four. I'm talking about corporate tax. It's not something like some random strategy out there. This is something that is very clear cut, guidelines and how to go about doing it.
Well, Yonah, this is a lot of great information. First of all, I want to recap some of the stuff you said. One, when you look at it, depreciation is one of the main reasons people even look to invest in real estate. Multifamily or passive investing opportunities, they're really key. And this cost segregation analysis allows us to take advantage of separating out the different components of a building and actually valuing them differently and being able to accelerate that depreciation based on those various components. I love the nugget you hit on towards the end there, where you talk about, if you're really looking to take advantage of this platform and this technique, look into things that have a faster acceleration rate, like golf courses, like senior living facilities, where you can maybe appreciate 60, 70, 80% of the asset, as opposed to more the 20% range for a multifamily. And then two, knowing that there are some drawbacks or things you at least have to keep in mind. One being depreciation recapture in particular, and the second being that if you're not a qualified real estate professional, or you don't have significant passive income from other investments or business ownership, you may not take full advantage of some of the benefits here. So lots of great information. Yonah, this is part one of our conversation with you, talking about cost segregation. Lots of great nuggets. We're going to jump into part two momentarily. So for those who are listening right now, make sure you check into the next episode, part two, with Yonah Weiss. We're going to talk about LinkedIn and how to be a LinkedIn superstar.